Hi, everyone. We're live. I am Debbie Schwartz, founder of Road to College and the Paying for College 101 Facebook group. I am here tonight with Angela Colatriano from College Ave Student Loans. And I'm trying to still see, maybe we need, all of a sudden, okay, we went from 0 to now 14 or 15 people are starting to watch. So I'd love, as people are coming on, if you could just say where you're from, how many kids you have, what year your kids are. I mean, I would hope that a majority of people here tonight have kids who are seniors, but I posted that even people with high school juniors and sophomores should come on, because this is a great introduction to what student loans are all about, and people should understand it even earlier in the process than what we do today. So who's ever out there, please, I'd love to see a post. Oh, yay. Okay, coming through. So somebody from Chicago with the senior. Okay, good. Somebody, your seniors starting college in the fall, and NYC, New York City, Minnesota. Okay, excellent. We definitely have from across the board here, from East Coast, West Coast, and in between. So for those of you who don't know, this is, I don't know, Angela, definitely the third year we've done this, right?
It might be the fourth.
I think it was the fourth too. Yeah, I was going to say it might even be the fourth. And so I love working with College Ave. As you can see, we've been doing it for almost 4 years. They are a great partner in helping to educate families about the whole process. And so we're thrilled to have Angela here tonight, who is the head of marketing at College Ave. And she's going to really kind of explain really important basics that families need to know about federal loans and about private loans. But I'd love, Angela, if you want to give a little background on yourself and also on College Ave.
Sure, I'd be happy to. So I'm Angela Colatriano, the CMO of College Ave, and I've spent my career in financial services, and I've spent the last many number of years in student loans, and I won't say the exact number. But College Ave actually is one of the top private lenders in the country, and we really started with a fairly simple premise, but we just really wanted to try to make borrowing and paying for college easier, and to try to take some of the stress out of that for families. So everything that we've done, from the way that we've structured our products to the content that we offer on our site and the tools that we offer on our site are designed to do that. And we're thrilled to be here with you, Debbie. We love what you do. We love the forum that you provide, and really appreciate being able to be here and share this information with families.
Well, thanks. So we're going to talk a lot about the different pieces of lending that families need to know, federal and private. But I want to pick up on what Angela said, because you guys should check out the College Ave website. And they have great tools that help you, figure out your monthly payment. But you have a tool where you can kind of change the different payments, right? Like if you want to see what it's going to cost you, if you want to pay it off in 5 years and in 10 years. And I think that that's really valuable for people who are fooling around with.
Yes, we have several calculators on the site. There is one that is a little bit more generic. So if you have an offer from someone else, or you have an existing loan that you want to better understand, you can plug any information you want to that calculator. And then we also offer similar versions, but that are very specific to the College Ave products. So if you want to see the choices that you could make on our loans and how that could change your monthly payments or change your total cost, you can also use a more specific calculator that will show you exactly how our products work.
Okay, and we're going to get into that a little bit, because people don't even realize that what you choose, affects ultimately the interest rate that you're offered, and what your monthly payment is, and what the total cost of the loan is. Okay, we're jumping ahead. So we're going to start basic, but important for everybody to understand. And really, maybe, like Angela, just give an outline of what are federal loans, and who can get federal loans.
Sure. So federal loans are issued directly by the federal government. So they will come to you after you complete the FAFSA, which we'll probably talk a little bit more about. That's your gateway to the federal loans. Really, they are accessible to virtually everyone probably who's on this call. So a common misconception is that, if you fill out the FAFSA, you won't get any aid. The most common types of federal loans are unsubsidized direct loans in the student's name, and they're not need-based. Essentially, if your student is attending a school at least half time, There are some requirements around the university, but if it's an accredited school and they're going at least half time, they're going to qualify for that money. There are other forms of aid that you can access through there as well that might be need-based based on your household income. But I think that's the most important thing to understand, that there are federal loans available which are accessible regardless of how much money you make or your credit score or anything along that line.
And so that's really important. I want to emphasize that, because people always say, I'm not going to get need-based aid. Do I need to fill out the FAFSA? And the reality is you really should, because if you want to do any sort of borrowing, the lowest borrowing is going to be from the federal government, and College Ave and every lender will tell you to max that out. And the only way you're going to get access to that is by filling out the FAFSA.
Yes, you always want to start with federal loans in the student's name first. Those are going to be the lowest interest rate. The student's going to be able to take them out on their own. And they come with special repayment benefits like public service forgiveness and those types of things. So if you need to borrow, that's always where you start.
Okay, so, and we'll go into, more detail even about the federal student loans. But besides what students can borrow from the government, what other options are there that the government provides?
Yes, so there are limits on what a student can borrow through the government. We'll talk more about that. But if those limits are reached and you still have a need, there are loans that parents can take out directly. And those are what we call the PLUS loans. Graduates can access them too, but I think probably for the purposes of this audience, we'll stick towards the undergraduate content. So parents do have an ability to take out those PLUS loans through the federal government. What's really important to understand, though, if you choose to take a Parent Plus loan, is that you're taking on the full responsibility for those loans. So the student is not on those loans. They are not legally responsible for those loans. You as the parent are taking on full responsibility for the Plus loan. And
who can generally get the Plus loan? I mean, are there criteria that the government is looking at, or is it a little bit more, wide open as to who has access to those loans?
Sure. So as I mentioned on the student side, when you're talking about the direct loans, there is no credit criteria. They're not looking at that at all. They're just looking at the student's enrollment, essentially. Are they enrolled and where are they enrolled? Once you get over into the Plus side, there are some basic credit criteria that the parent does need to meet. It is relatively simple, I would say, and certainly less restrictive than you would see in the private borrowing space. But there are a few restrictions, primarily around whether or not there are any defaults on existing student loans. So if the parent had a student loan in their own name and did not pay back their own student loans, then that would be something that would prevent you from borrowing through the Plus program. But it is fairly wide open, I would say.
Okay. Yeah. So it's there are cases where people get denied, but it's pretty lenient, compared to other loans that people can get.
That's right.
And what about who can actually take the Parent Plus loan? I know it's called Parent Plus, but people still ask that, can a grandparent, take out the Parent Plus loan for a student?
Yeah, it's an important distinction. So you do need to be a parent in order to access the Plus loans. And once we get to the point where we start to talk about when do you want to shop private loans and what are some of the differences, that is a difference that you will see on the private side.
Right. Okay. So hopefully people who have listened so far, you've taken away that the FAFSA is important. If you're going to need to borrow, it's the only way it's going to give you access to federal loans. Students should absolutely max out the the federal loans. I was looking because there's two different names that I still constantly see all the time. They call them the direct federal loans or the Stafford loans.
Yes.
I think that's just isn't Stafford more of like the older term, but it's still used.
It is. Technically, they're all direct loans now, but you will see some places where if you're reading content and that type of thing, where they almost use Stafford interchangeably, but that really is referring to an older federal program.
Right. So I'm just looking and I see a quick question maybe we can answer. Allison is saying, can you take out Plus loans as a parent if you're still paying off loans?
That's an interesting question. As far as I know, as long as the loans that you have are in good standing, I don't believe that would impact your ability to take out a Plus loan for your student. One thing I do want to hit early on here is that studentaid.gov is the federal site for all of the information on the federal loans. So certainly if you have any specific questions like that, that is a fantastic resource and the best place to go to get more information about federal loans.
Okay, so let's dig in a little bit about the direct student loans from the government, because I think you touched on it really quickly so far. There's unsubsidized and subsidized. So yes. What does that mean, and why would somebody get, one version versus the other?
So the unsubsidized are the most common, and those are the ones I described that really don't have any need-based criteria. The subsidized loans are need-based. So whether or not you qualify for your loan to be subsidized is going to be based on your family's income. And what it really means if you get a subsidized loan is that the government is essentially covering the interest while the student is in school. So it's not exactly how it works, but essentially you have a 0% interest rate during school if you qualify for the subsidized loans. So if you qualify for subsidized, you would want that first, but there is you can't take out as much in subsidized loans as you can in unsubsidized. So sometimes you may cap out on what you can take in the subsidized portion.
And I think people might have also seen in college offers that they got from schools is that even that the subsidized loan might have varied from school to school into how much they receive. But ultimately, it's a combination of your EFC and what the school's costs are that determine whether or not they're going to give you a subsidized loan.
That's right. Your family's need is going to play into that.
We kind of talked a little bit right before we started about the rate of the direct federal loans, and they just were announced. I'll say what the rates are, and we'll talk a little bit about that. So the direct rate, the interest rate for direct federal student loans is 3.734. And there is an origination fee, which I see somebody already asked about that. I'm going to say what the fee is, and then I'm going to ask Angela to explain what that means. But there's a fee of 1.062.
That's right. So the origination fee is essentially the fee that the government charges for dispersing the loan. And the way that the origination fees work on all of the federal loans is that they actually get bundled into the loan amount. So again, it's a percentage of what you borrow, and it actually gets bundled into the loan that you're taking out, and then that's how you repay the fee in addition to the loan.
But maybe just to make that more clear, because I know that people get confused with that, and I'll just make up like a simple example. But if you borrowed $1,000, right, and it had this origination fee, you have to pay. You've borrowed the $1,000. You'll have to pay interest on the $1,000, but whatever the net is, let's say it comes out to $950. That's what actually gets sent to the school.
Yes, that's right.
So that's how that origination fee kind of comes out of the amount that people borrow. And I say that because people, like when they're figuring out their numbers and then they end up being off, it's usually because they didn't factor in the origination fee.
That's a very good point. Yes.
Okay, so here's a quick question from Rich. Can you pay interest on unsubsidized while in school?
You can, and you should. But the one thing I will tell you is if you want to do that, you're going to have to be proactive to determine how much that is and where to make your payments, because usually the payments on federal loans don't begin until after the student leaves school. And that's when you will always begin receiving statements, and you'll know what's due, and you'll have your payment schedule and that type of thing. If you want to start making those payments while the student is in school, because they're not expecting them, you might need to take the action to reach out to the servicer and find out how much should you be paying, where should you be sending the payments. So it's a great idea. Just know that you might need to take that step to make sure you know how much to pay and where.
And you know what, maybe we should explain on federal loans, and then when does the interest start accruing? When do you need to pay it back? Mm-hmm. Because there's a little bit of leeway.
Sure. So with let's just stick with the unsubsidized loans, just for lack of confusion. So with the unsubsidized loans, the interest does start accruing as soon as the money goes out to the door to the school. And in terms of when you need to begin paying the loans back, it's actually 6 months after the student leaves school. So you do have a grace period. before the payments become due after the student leaves school.
Okay. And then, as I think Rich mentioned, if people want to get a jump on it, and a lot of people do, they'll say, particularly a parent will say, I'm going to pay the interest while my student's in college. So that doesn't, start accruing. It's definitely possible. But as Angela said, you're going to have to make sure that you know exactly how that is done, because, it's not something that's automatically going to be presented to you.
And that is one of the differences that you will find when you are borrowing through the private side. At College Ave, for instance, we actually do have an interest-only option. So we make it easy and accessible for you to opt in to do that, so that you can, you have a plan. Again, you know exactly what you need to do and when you need to do it, where you send the payments, and you're also establishing that behavior. So you will find that that's a bit of a difference between the federal side and the private side, that you may have options like that that are baked into the loan, so to speak, versus something that you need to go seek out.
So you also touched on for federal student loans, and that's kind of what we've been talking about right now, that there are limits. So there is going to be a maximum that a student on their own is going to be able to borrow from the government. That's
right. So we talked about the fact that you always want to start, if you need to borrow, you always want to start by maxing out those loans that are through the federal government and are in the student's name. The limits on those, you can only borrow $5,500 for the freshman year. You can borrow $6,500 for their second year. And then for their third year and beyond, you can borrow $7,500 a year. And the max is $31,000. And the course of time that you can take to do that, there's actually a calculation. It's like 150% of the program. The easy way to think about it is if they're going to school for 4 years, I think you can usually take federal loans for up to 6 years and up to that $31,000 aggregate cap. So that's often the reason why families may find that they need to explore the private loan space, because there are limits to how much a student can borrow in their own name through the federal program.
And if, I'm going to say a big if there are parents here that have sophomores and juniors, like this is, I think, that piece of information that Angela just shared about the limits, the yearly limits, I think is what people are shocked about, because they don't really look into loans early on. And so they just, assume there's this phrase, oh, well, we'll figure it out. And then all of a sudden they hear, oh, that there's a maximum, and they didn't realize that. And so if you're a family of a sophomore or a junior, take note of that there are maximums that your student can borrow from the federal government. And so that may impact, kind of the types of schools and the costs of schools that you're going to want to look at.
Yes. It's an important factor.
And I saw a comment actually in our Paying for College group 101 before I got on here. And people were saying, with mortgage rates, I mean, they're kind of on the low side. I'm not going to quote a mortgage rate because I don't know what it is, but and somebody was saying, well, why are even like, the rate that just came out for the direct federal loan, the 3.735, why is that higher than possibly like a mortgage? And maybe you can talk a little bit about the fact that there's no security related to this loan.
That's right. So it's, I can understand why people want to make that comparison, but really a student loan is not like a mortgage or an auto loan, because in both of those cases, you actually have an asset that is securing the loan. So you are holding something that is physically worth something, and that is helping to secure the loan. And that's why the interest rates are lower. A student loan is unsecured. There is no physical, tangible thing that is worth money that's attached to it. I mean, there's the degree, but you're not going to go take back somebody's degree.
And you can't go sell it someplace.
And you can't go sell it somewhere. That's right. Nobody else could do anything with it. So really, student loans are unsecured debt. And so if you think of them from that perspective, what you would be better to compare them to is say, what are your credit cards priced at? What is a personal loan priced at? Because those are other types of unsecured debt that would be more applicable. And I think when you look at it from that perspective, even though I know families did see that those federal rates go up this year from where they were set last year, again, especially if you look at the undergrad rate, it's still a very compelling interest rate, especially for a student who really has no credit history or income to be able to borrow on their own at that, incredibly low unsecured rate.
Yeah, again, Angela and I were talking before we got on, and I get the new rate is 3.734, and it did go up. I think it was 2.5 something, but honestly, in the past 5 years, this is still a very relatively low rate compared to what they were pre-pandemic, which were in this, the high fives, the low sixes. So, it's still the direct, federal loan is the best one for your student to get. It's actually, I'm just going to make one more emphasis. It's the only loan that they can get without a cosigner too.
That's right.
So, okay. So I think we've given everybody a good chunk of information related to the direct federal student loans. So let's maybe talk a little bit about Parent Plus loans and also the private loans. So how would that's always the big question. Like which do I go for? Maybe you can explain a little bit more about private loans, and then we can explain how somebody would compare the two.
Sure. So actually, here's what I would say. Usually once people get to the point where they're considering a plus loan, that's where we say you should bring private loans into the conversation. And what we tend to find is that there are kind of two key gating factors as people decide, do they want to go plus or do they want to go on the private side? And one of those key factors is, do they want to take the debt on entirely by themselves, or do they want the student to share in that responsibility? Because that's actually one of the biggest gating factors, quite frankly, why people will choose to go with a private loan over the plus loan. On the private side, the most common type of loan that you're going to find, the common type of student loan, is going to actually be a student loan with a cosigner. So the parent is not completely off the hook for this, and the cosigner doesn't have to be the parent. That's just a really common situation. So that's sort of what I'll use for examples here. The parent will often join the loan with the student, because the traditional student does not have enough income or credit history to qualify for that loan on their own. And the parent can then share that responsibility, though, and share that legal responsibility with the student instead of taking it on completely themselves. The other difference that you can find is once you get into plus territory, the interest rates on plus are higher. The origination fees on plus are higher. And that is an important factor to make sure you're sort of comparing apples to apples if you're thinking about federal, or if you're thinking about federal plus versus a private loan. So some people, their credit profile will actually enable them to get a lower rate or better pricing with a private loan versus the parent plus loan. So those are usually the factors that we see in play. Who do you want to be responsible for the debt? And can you get, where will you get the best interest rate?
And let me just share what the new interest rate is on the plus loan. It is 6.284. And this is what Angela was talking about. There is an origination fee, which is 4.248%, which is kind of hefty. And, I will, and I normally do the math, but I will just say as a quick estimate, usually that level of an origination fee really increases the loan interest rate like 1 basis point. So that 6.284 I mentioned, if you factor in the fee, it's probably closer to 7%.
Yes, that's right. And so once you get into that territory, you may be able to find competitive pricing in the private loan side where that would be more compelling.
So maybe you can explain a little bit about that when you say more competitive pricing. If I've got good credit, am I going to get a different rate on that Parent Plus loan, or who gets that rate? Are there different rates for the Parent Plus loan?
Yes. So, as we described, you do have some basic credit qualifications that you need to meet to qualify for the plus loan, but then everyone who qualifies for that loan gets the exact same rate and the exact same fee. On the private side, your eligibility is going to be based on your credit, and you will have more criteria that will come into play than on the federal side. And then in addition to that, though, the pricing is actually going to be set based on your credit. So if you have a positive credit history, then you may be able to qualify for a better rate than you can on the plus side, since they're not taking your credit history into account.
Right. So the Parent Plus loan interest rate is kind of like, if I don't have good credit, it's probably a good deal. But if I have good credit, I'm probably not getting the best rate if I'm looking at the Parent Plus loan, because it's lumping everybody together.
That's exactly right. It's at least worth shopping around to see.
Okay, and that's really important that you just said, and I know, and I sympathize with all of the families on here who have high school seniors, and I have a high school senior, and I just went through this whole big process of admissions, and I know we feel exhausted, but you have to kind of spend a little bit more time over the next 2 months and continue to do research. And this time you're going to shift your research to researching and understanding student loans and shop around. You should see, A, can you get a better rate than the Parent Plus loan? And B, where can you get that, better rate from? And then kind of gather your information and make decisions. Don't make a decision before shopping and finding out the right information.
Particularly once you get into that decision point where you decided that at least considering private student loans is right for you, because once you go from, we talked about the fact that the federal program it's basically cookie cutter for everyone. Once you get into the private side, you're dealing with individual lenders who may have different terms on their loans. They may have different choices that you can make. They're going to have potentially different interest rates. I will tell you that origination fees are not at all common in private loans. It's something that it certainly can't hurt to verify before you make your selection, but they're not common on the private side. So that's probably not where you're going to find the differentiation. But each lender can set their own rules and benefits. And so you will want to shop around on the private side to make sure that you find the provider that you think has the best options for you.
So along with that, this idea of shopping around, and whenever it comes to, loan products, people are always nervous that how can I get an idea of what my interest rate is before I actually commit to that lender and without it hurting my credit score?
Mm-hmm. So some lenders, College Ave is one of them, do offer pre-qualification. So you can actually enter some basic information and get an idea of whether you'll be approved and often what type of interest rate you could anticipate. So you might get a much tighter range than you see, just advertised in the market, and you can understand where you would fall. It's not a guarantee, but it will be very helpful in helping you just sort of compare lenders and make that decision on where you want to apply.
So there really shouldn't be any harm of somebody going and getting a pre-qualified, finding out what their pre-qualification interest rate is, and they'll get just a tighter idea of what the interest range is that they might get.
That's exactly right. It's what's referred to as a soft hit on your credit bureau. So it will not impact your credit score by pre-qualifying.
And somebody asked, and these are great questions, and I only kind of chuckle because we see them all the time, but they make sense that people ask these questions. When do they need to start this process?
I think we do this one every year.
Right.
But it is a really great question because you, especially for everyone who's going through this for the first time, of course you need to know that. So what we usually say is, start with when either the bill's going to be due or when your kid's going to school, and then back that up by, let's say, 60 to 90 days. So around this time, what you should be doing is starting to look around. You should be starting to determine, what do you think your costs are going to be? Who are the lenders? Do you think you're going to be able to cover everything with the federal loan? Do you think you want to shop private? Who are the private lenders? You're just sort of in your information gathering, mode right now. And then at least 30 days before the bill is due is what I would recommend. You want to get your private student loan application in. And in addition to that, if you are going to shop, you want to do all of your shopping where you actually apply and people are actually pulling your credit bureau and it is having an impact on your credit bureau. You want to do all of that within about a 30-day window, because the credit bureaus, I think all the major ones do, group those inquiries and they recognize that you're shopping. So it has less of an impact on your credit score because they recognize that you're shopping in this category. So right now you're in preparation mode. Have some idea of when that bill is going to be ready, and make sure that your application for a loan gets in at least 30 days before that bill is due.
So somebody asked that, and I'm so glad that you brought that up, can I, here it is, exactly. Does applying at several private lenders affect your score? And just to reiterate what Angela just said, if you do it within this 30-day period, it won't. So they know, meaning the credit bureaus know that you need to shop around. And so you should take advantage of that. And
it'll count more as kind of one inquiry versus multiple. So it could have a bit of an impact on your score, but that's going to be better than it counting as 3 inquiries or 4 inquiries or
right. So it will impact because it's all going to look like one inquiry instead of all these multiple inquiries happening.
That's right. So you shouldn't be afraid to shop for that reason, as long as you try to do it in the condensed time frame.
Okay, so you started to touch upon it, and I think now would be a good time to talk about the different features of a private loan, and kind of like I view them as like levers, like people can kind of like, change one thing, change another, and it impacts, that loan, the interest rate that they might get. So maybe just explain what all these features are and how people can change them.
Yes. So here's what I would say. Every private student loan is going to be probably a little bit different because, again, each lender sets their own rules. So I will tell you, though, that it is, in some cases, you're going to find options where you can choose whether or not to start making in-school payments and how much to pay. That is something you can do at College Ave. So we offer the choice of making as little as a $25 payment per month each month while the student is in school, paying the interest while the student is in school, starting to make your full principal and interest payments immediately, or students can defer, families can defer until the student leaves school if that's what they need to do. And we also incent you, if you're able to commit to an in-school payment, even as little as $25, we actually incent that with lower interest rates. So you will get a lower interest rate by committing to make $25 payments each month during school versus deferring until after school. And then on top of that, we also give you the choice of how many years you take to repay the loan. Not every lender does that. So it might be more common to find some of those in-school repayments with or without an interest rate discount. Not everyone will necessarily price the way that we do. But we also give you the choice of how many years you take to repay. So you can take as little as 5 years or as many as 15 years, and we have a few options in between. And really the combination of the in-school repayment option and the how many years do you take to pay the loan back gives you a lot of control over what your monthly payments are during school, after school, and what you're paying in total cost for the loan. So you can zero in on what matters the most to you and what's actually going to work for your budget, and really find a combination that fits your life. And then on top of that, what's also common in terms of choice on the private side is the ability to pick between a variable rate or a fixed rate. So on the federal side, everything is fixed rate. On the private side, you're often given that choice between a variable or a fixed. And variable rates are basically moved with the market. So we use LIBOR as the index. So the rate can flex up and down with the market. And the variable rate, if you were to choose a variable rate loan, it usually starts at a lower price point than the fixed rate that you would be offered at the same time. And that's because the lender is taking on less risk because they know that the rate is going to move with the market. So they're able to offer a lower rate. So that really comes down to your comfort level with understanding that the rate can change, that can adjust your monthly payments a little bit, and what your comfort level is with a variable rate product. But that is a benefit on the private loan side that you actually have a choice.
And I've heard people kind of also suggest, if you're gonna have a payment term that's like 5 years, on the shorter side, you might be more comfortable with a variable rate, as opposed to picking variable and going out, 15 or 20 years. That's a long time not really knowing what's going to happen with that interest rate.
It is often a factor that people consider. I mean, I think you really do have to think about there's no right or wrong. There's no good or bad. One isn't better than the other. But you're right, Debbie. Often people will consider how long do they intend to be paying that loan back. And that might influence how they think about a variable rate because you have a longer period of time where you have risk of the rate moving. I will tell you, though, I think a lot of times what we hear, and again, there's no good or bad. If you prefer fixed rates, there's absolutely nothing wrong with that. But sometimes people get worried about that idea that the monthly payment can change. And on loans of the size that people are typically taking out for school, that the payment doesn't usually change by that much. It usually changes by more like pennies, dollars. It is a smaller change than I think people sometimes just imagine it will be.
Right.
So I would say if you're even thinking you might be interested in it, it's probably worth a little bit of research to figure out if that might be the best choice for you.
So there is a question here, which I'm sure other people are wondering, what if I decide that I want to pay off the loan early? And that would be great. Is there a penalty with that?
So on the federal side, I will tell you there are no penalties. On the private side, I would say they're uncommon. So certainly at College Ave, we do not have any prepayment penalties. So you don't have to worry that if you pay off early, you're going to get hit with fees or anything like that. Again, once you're on the private side, though, it is up to each individual lender. So if that's something that you're interested in, you should double check it. But it's not common for there to be prepayment penalties.
And that's a really good point that you just made, Angela, that, and Angela can't speak to all the private lenders. She knows, in detail, obviously, about College Ave, and she's just kind of describing, how the industry works. But it's really important to kind of to find out all the specifics at each lender if you're looking at different lenders, because they might vary, and so you just need to know. And I mean, one area which I've seen them vary, maybe you could talk a little bit about this, is a cosigner release.
Sure. Yeah, so cosigner release is something that's really unique to the student loan industry, quite frankly. Like I'm sure you probably have some people on here who have, maybe been on a joint mortgage, and usually once you're on a joint loan of some sort, it's usually pretty hard to get off of that loan. Private student loans are a little bit of a different animal, and I think lenders recognize that parents in many cases are joining these loans to help their students get the utility of that degree. But it is really the student who benefits from that, and they, in many cases, are the ones who will go on to pay off the loan. So with that in mind, several private lenders do offer cosigner release, but not everyone does. And the terms of cosigner release are usually different with each lender. So what I would say is, if that's something that matters to you, if you think that you're going to need or want to be removed from the private student loan, then you want to make sure that you know whether or not the lender even offers that.
Mm-hmm.
And if they do, what are their rules to qualify? Because there are some lenders out there who may offer it, but they essentially offer it at their discretion. So you can request it and they may or may not grant it. And you might not know what criteria you need to meet in order to qualify. So I will say that, College Ave, I would encourage you to go on our website and look at the full details, but we actually have, very clear stipulations that as long as the student or the loan meets those criteria, we will release the cosigner. So I would just say, if it's something you're interested in, make sure that whether or not the lender offers it, and make sure that you're clear on what the criteria will be to qualify.
Yeah, I find that is one of the features that parents are most interested in knowing about. And again, I encourage everybody, whatever lender that they're looking at, to, as Angela said, find out like all the requirements around that being released, because, a lot of parents are willing to co-sign, to help their student get the money through for college and maybe for a year or two after, but they want to know at some point that they can come off of the loan.
Right. I will say too, and this actually dovetails maybe into a wider conversation as well, Debbie, that if you're going to co-sign a loan with your student, it's really important too to sit down and really have a conversation with your student about what that means. Because if you're both in it together, you want to be clear with each other about what your expectations are about who is paying and when. So we will often see that parents might say, I'm co-signing this loan for you. I'm going to make the interest payments while you're in school. I expect you to start making the payments in full once you graduate. That's a handshake agreement between the two of you, but it's important that you both understand, kind of what your rules of engagement are, and that you both understand that technically, even if you've kind of had that handshake agreement, that you're both legally on the hook for the loan, and it's affecting both of your credit. So if somebody doesn't hold up their end of the bargain, it's affecting both of you. So, there's good and bad in that, because having student loans can actually help your student start to build credit and start to establish a credit history. And as long as, payments are being made, then they're establishing a positive credit history. But if somebody lets down their end of the deal, then you could have, an impact that you didn't expect on your credit. And I think the cosigner release, the reason I bring it up in that context is because in order to qualify virtually anywhere, you're probably going to need to show positive credit and positive repayment history on that loan. So don't assume that you would co-sign the loan And then if your student's not making the payments, that you're going to be able to qualify for that cosigner release.
Right. And you also mentioned something I think that's pretty important too, that that loan, probably also shows up on the credit history of the parent, and any comments or advice about what parents should kind of consider. Everybody, I find, and I understand, with college planning, they're kind of looking at 1 year at a time. And so like, how am I going to get through the first year? But you have to think of all 4 years and how that might affect what you can borrow, who's going to be the cosigner, that type of stuff.
Yes, you do. I mean, I think there's probably some combination, right? Because you usually do only borrow a year at a time. And it is hard to know exactly what junior year is going to look like in terms of, are you going to have labs? Are you going to study abroad? It's difficult to project all of that, but it is good to at least map out a high level plan of how you intend to pay, so that you do know, where you maybe have some of those things that you need to keep an eye on, like, how do I make sure that I maintain a positive credit history, because I may need to come back and borrow in 3 years.
Right.
Or sometimes we see parents trade off, and we see maybe mom cosign freshman year and dad cosign sophomore year. So sometimes we see parents share in that way. But it is something that you want to have at least a high level plan, if you can, before you go into the first year.
And especially for families where, there might be multiple kids that are somewhat close together, maybe even, within 2 years apart, there's going to be an overlap. And so, if you're co-signing for 2 kids at once, multiple years, you should probably, do yourself a favor and just sit down one evening and think it through.
Right.
It's doable, but just, have a little bit of a plan in place.
That's absolutely right.
And actually talk about, somebody asked this a little earlier about everything we're talking about. Like, does this happen every year, or can I take out a loan for all 4 years?
So everything really happens again every year. So it starts with the FAFSA. You do the FAFSA every single year. And then really what we see people on the federal and the private loan side do is then they come back each year once they know what they need to borrow. And you typically borrow for either a semester at a time or an academic year at a time. But you don't really borrow for 4 years at once, meaning you don't take a lump sum of money for 4 years, and then dole it out as you need it. You really come back and reaccess.
And you just mentioned, taking for the year versus a semester. So can somebody do that? Can they just say, like, I don't know what my situation is for the full year. I might just need it for the first semester, and then I guess I'll come back if I need it more for the second semester?
They can. So you have that's the most common way that people borrow. They will either pick to borrow by each semester, and they'll borrow for the fall and then come back again and borrow for winter or borrow for spring, or they will borrow for the full academic year up front. And I think the important thing in making that choice, because again, there's no right or wrong, there's no good or bad. It's what you are comfortable with and what you have line of sight to know that you will need. But one of the things I think is important to know is that when you borrow for the full academic year, the money doesn't all go to the school at one time. So you're not paying interest on a portion of that loan that you didn't need early. So what will typically happen when you apply for the loan, and actually this goes back to why it's important to apply at least 30 days before your bill is due, because when you apply for the loan, you can find out pretty quickly whether or not you're approved and what your terms are and that type of thing. But then part of the student loan process is that the loan actually has to go to the college to be certified. And what that means is that the college confirms, yes, that student is enrolled. Yes, they still need that money. They've not already maximized their cost of attendance through scholarships and that type of thing. And then they also echo back, here's when we want you to send us the money. So if you borrow for a full academic year, what the school will typically do, let's just use like a $10,000 loan because it's just nice and round. What the school would typically do is say, okay, send us $5,000 in September, and then send us the next $5,000 in like roughly January is when the second disbursement would usually go out. So when we send the first $5,000, you're only accruing interest on that first $5,000. You don't actually start getting charged interest on the second half until it actually goes out the door. So I know that's sometimes a fear for people where they would, for convenience purposes, maybe like to go ahead and apply for the full academic year, but they're worried that they're going to be paying interest they don't need to be paying.
So I guess along that example, if a family figures out that the second half of the year, they applied money for the full year, money went out for the first semester, but they realized in the second semester they have found other ways of covering it. Can they say, we don't need the rest of the money?
Yes. So it's always easier, I would say, or it's generally easier to have it maybe a little bit more on the loan and then either reduce it, return it, cancel it, than it is to try to come back for just a little bit more. Part of what plays into that is that there are minimum loan amounts. So at College Ave, you need to borrow at least $1,000. Other lenders have different minimums. I think I've seen everything from, like I said, we're 1,000. I think I've seen even like some that have a minimum of 5,000. So it can be harder if you realize you need just a little bit more to come back and get that loan versus saying, I'm approved for that 10,000 and then I find out I don't need 2,000 in January, no problem, I don't take that.
Okay, that makes sense. Okay, let's see what other questions we have. So Andrew's saying, what sort of credit criteria is there for a private loan cosigner? Like as the cosigner, particularly actually if you have two parents, like what would you be looking at to decide who might be a better cosigner?
Yeah, so I would say, again, it's going to differ lender by lender. If you think about what your credit score is, that's usually, it might not be the exact criteria that they're looking at, but it's a sort of a good directional indicator. Usually you're going to want to be sort of at least the mid 600s or higher. And then on top of that, lenders may also be looking for certain things like debt to income ratios. So how much income do you have? How much debt do you already have? They may also be looking for things like how long have you had credit? So what's the length of your credit history, or how many different kinds of credit do you have? So all of those different factors can come into play in determining eligibility and pricing.
And we don't usually talk about this, but anything you can talk about relative to private loans and whether international students are eligible?
So we do offer loans for international students. We do require a U.S. Social Security number, and we also do require that an international student have a U.S. based cosigner. There may be other options out there, but I would say it's I'll say it's not uncommon in the private student loan space to need a U.S. based cosigner for an international student. It's not to say there aren't options out there, but that is on the common side.
Okay, let's see what else we have here. Oh, okay, this is a good one. Good question. Are the private loans separate from school year to school year, or are you just adding money to the same loan?
They're technically different loans, but usually, and again, I'm going to kind of speak for College Ave. I can't promise you that every single lender would work this way. They're technically different loans, but we keep them grouped together so that when you get your statement and you have your payment due, you're not managing 6 different due dates in a month. So they are technically separate. You would probably see them listed separately on a statement, but we do things from a servicing perspective to make it feel like you only have, one payment.
And I guess I'm going to ask if this situation can happen. I hope it doesn't happen that often, but I mean, could like in year 3 or 4 potentially could a student be declined, because they are technically separate loans?
It is possible. I mean, there's certain times where if there's major changes in your credit profile or things along that line, or, maybe if you reach, really significant borrowing limits, I would not say that that's common. Really what we see is that, as long as students are coming back with cosigners, really they have, 90% plus approval rates. So I would say for the most part, barring some significant change or really large increases in debt, it's not typically a problem.
So we touched on this, but maybe talk a little bit more about on the federal side. We talked about that there are definitely limits to how much a student can borrow with the federal government. What is the limit on the private side about, the borrower, cosigner, what's the limit on how much you can borrow in that loan?
It's not always hard and fast, and it's going to differ from lender to lender. You're not going to see the same aggregate. You're not going to see that same annual limit. Like we discussed for the federal loan, that a student can only borrow $5,500 in their name. You're not going to see that type of limit on the private loan side. What you would typically see is that the cost of attendance is probably going to be your cap. And again, that gets back to the school certifying what are the costs of the program and the living expenses for your student. And do they have visibility into your family already, maxing out and having enough loans or other aid that would already reach that cost of attendance? So that's much more likely to be the cap, so to speak, on the private student loan side. And then, yes, I mean, if you have, a significant level of debt, it's also possible that you would hit aggregate limits. But for the most part, what you would find would be your limiting factor would be your cost of attendance for that given semester or academic year.
Right. And so that's why it actually might change year to year. If the cost of attendance is going to change, you would basically be able to borrow a little bit more to make it up to the cost of attendance.
That's right. And the cost of attendance, is really going to depend on, again, what is your student's living situation, of what classes are they signed up for? Again, if you have, if you're taking a major where you have a significant number of labs or things along that line, you will have a higher cost of attendance than somebody who doesn't have that. So there are some individualized factors, I would say, to the cost of attendance. And if you have any concerns about whether or not you're going to be able to borrow enough, that your financial aid office would be able to help you understand what your cost of attendance is.
Okay, so here is a grandparent. Anything different for grandparents that are helping out with tuition and loans? Anything that they need to be aware of that's different than an actual parent?
So I would say on the private side, if a grandparent elects to co-sign the loan, they have that option. And actually, we have parent loans on the private side as well.
Yeah, I was going to explain what a parent loan is on the private side.
They're really, they might almost be better named sponsor loans, because we don't require that the individual be a parent. They just need to be a credit-worthy individual who wants to take on the full responsibility for that student, the paying for that student's education. But long story short, if a grandparent elects to sign on for one of those things, there really isn't any difference. They are in the same responsibility position as a parent would be. And as I mentioned before, they would not be eligible for the Parent Plus loan on the federal side, because they would need to be a parent.
Okay, so Angela just mentioned, and maybe just that there on the private side, there are private student loans. So that's when a student is a borrower with a cosigner. But there are this category of loans, and not every lender offers it, but College Ave does, called, I guess they're called private parent loans, or maybe private sponsor loans. And just how is that different than the private student loan?
Sure. So we do call it a parent loan because that is the most common use case. Quite frankly, it is a parent who is the most common person who's taking that out. They are different from a student loan in that the student is not on that loan. So it is going to the school. It's going to go through that same process that I described. The funds are going to be sent to the school, but the parent or other creditworthy individual that is not the student is the only one legally responsible for that loan. The student is not on the loan in any way, shape, or form, has no responsibility to repay.
So as you can see, a lot of all the different loans that we've talked about, one of the big factors is who's the actual borrower, who's responsible for it. And so you can, choose your lane, or of how you want to do it, whether you want to be as a parent, you want to be the sole person responsible. That would be either a Parent Plus loan or possibly like this private parent loan. Or if you want your student involved, then it would be a private student loan where you're a cosigner. So that seems to be like a pretty important distinction, and something important that families should be thinking about and kind of considering when they decide which types of loans to go after.
Yes, that's right. And one thing, I think we've probably touched on this already, but I do think it's worth mentioning because it is a question that we get quite a lot, especially to your point, Debbie, when people don't realize that the federal loans in the student's name are capped each year where they are. We do get that question of, can the student borrow? Can they take a private loan that's solely in their name? And the reality is that most private lenders just cannot give a student who does not have current income and who doesn't have that credit history or that positive credit profile that we talked about. They just can't qualify on their loan. The lender is not able to give them a loan by themselves. So if you are thinking about borrowing in the private space, I think you really do have to recognize as a family that student is going to need someone who does have that credit history and income to be able to qualify for the private loan. It's just highly unlikely that they would be able to get anything on their own.
And just to reiterate, I mean, most times it is a parent, but it doesn't have to be a parent.
That's
a
right.
grandparent can play that role. I actually have a friend who's an aunt. She plays that role.
Yes.
So
yeah.
And
it just needs to be a credit-worthy, adult, but they will need to have sufficient income and credit to qualify.
So, what about during this, season of when people get loans, does the interest rate on private loans change? Like if I were to go today and, apply for a loan, I would be offered a certain interest rate. If I went in the middle of July, am I going to get the same interest rate if nothing else has changed with my financial situation?
Yeah, I mean, you'll probably see a little bit of movement because lenders at any given time are trying to match the rates that they're offering to essentially what it costs them to lend money. So you may see a little bit of movement, but I wouldn't say that there's a season per se or a perfect time to, this is the best time to go. This is when you're going to get the best rate. I wouldn't say that necessarily exists.
Okay. Yeah. I just wanted to bring that up because I know sometimes people have said to me, well, I saw that the rate changed from last week to this week, but as you said, they are very minor changes that happen. It's not like, it's going to be several percentage points that, it's going to change over even the whole season.
That's right. Something, really significant externally would have to happen for that. You're right. You would see relatively moderate changes if you see them.
Okay. Here's an interesting question. Can private loans from various lenders be consolidated into one loan down the road?
They can. So the one thing is that sometimes people get hung up on the terminology around consolidation and refinance. I think part of it is because there is a federal consolidation program. So sometimes it gets confusing. So you could not take private loans and put them into the federal consolidation program, but you could take private loans and refinance them. College Ave actually offers refinance as well for graduates, so that you can refinance those student loans down the road if you desire to, and if you qualify for better terms.
And when can that refinancing happen? Like somebody once asked me, can I refinance? My student is going to be a junior, and we took money out in freshman and sophomore year. Can we refinance that money now?
Usually you need to have graduated. So usually the student needs to have the utility of the degree that they were pursuing. I don't want to say always, because again, it could differ, but usually they need to have graduated. And then usually they need a little bit of time to establish themselves. And again, establish that credit history, establish that income, before they're probably going to either qualify for terms where you would say, yes, I want to trade this thing for that thing, qualify for better terms. So usually they're going to need to graduate and they're going to need to get a few years out of school. It's not the hard and fast rule, but it's a reasonable expectation to have.
Okay, so there's one other topic, and this is a sensitive topic, and I know people want to talk about it, but I think it's a fair thing, particularly when you're taking out loans. And it's unfortunately about if what's a situation of whether the student unfortunately passes away or whether a parent who might have co-signed passes away. Like what happens in that case to these loans?
Sure. So this is one where I would say, again, it can vary lender to lender, but I'll give you our answer. And I think that our answer is probably on the common side is what I would say. So if the student who received the benefit of the loan passes away, it is usually forgiven, or has a permanent disability. It's usually forgiven. If the co-signer passes away, so let's say it's a student loan, the student who received the benefit of the education is still alive and the co-signer passes away. In College Ave's case, at least, what we allow that borrower to do is just continue to repay the loan. So it's not forgiven in that case. The student borrower has the option, though, to just continue repaying on their original terms. And then obviously if the loss of that cosigner changes their ability to pay, then we want them to contact us and we'll try to work with them.
And any, advice, I guess, even related to life insurance, is this is in the situations that you just talked about, is that why a family might consider taking out, life insurance on a student, or, if any of these, unfortunately, yeah, well, actually, you said if the student passes away, then it's discharged. So
it's often discharged if the student passes away. So, personally, I would say if you're considering that, I would double check all of your terms, because you may find that it is not necessary for you to cover that, to cover the student loans, if you're concerned about whether or not you have the right life insurance level for a child who you have student loans for. In the case of the cosigner, I think that would be a personal decision whether or not you want to have sufficient insurance that could go to the student in order to pay off the loan. But on the student side, it is usually forgiven.
So I'm not exactly sure what Chris is asking, but the way I read it, I'm going to maybe interpret his question. If parents are cosigners, can they refinance? What I'm thinking when I read this is, and I never really thought about this, but can you change the cosigner on a loan, like after you've started it?
Not usually. I would say it's not easy to swap cosigners. If you did want to do that, I think you probably would need to go through a refinance. In terms of whether or not the cosigner could refinance, though, it's just a bit of a tricky situation, because there may be ways that you could refinance if you were trying to move all of the loans only to your name, but the student would need to have graduated if you're trying to refinance something in both of your names. I don't know if that helped.
I'm not sure. That question hasn't really come up before. Okay, so one last question, and then we're going to wrap it up. Is it too early? And we kind of talked about this, but this is an important one. I know people kind of always are concerned. Is it too early to apply for private loans now if the interest rate isn't going to be charged until the amount is paid out to the college?
No, it's not too early. And my answer is always, as soon as you think you know what you need, apply, because you're better off to get into that cycle, because the school has to play a role, and really there's pieces of that because the school is involved, which are outside of your control and or even outside of our control to some extent in terms of how long they can take. So it's definitely not too early if you think you know what you need. I would say that if your student has not finalized their course selections or has not finalized some of their living arrangements, it's possible that the school won't certify the loan right away, but it won't get canceled. They'll just wait until they have that information, and then they'll send it back to us. So as soon as you know what you need, if your child's going in the fall, as soon as you know what you need, go ahead and apply.
And then do you find, like, if people do wait to that August timeframe, is there sometimes a little bit of a delay from the college side because they're getting, a lot of, school certifications all at once? But do they ultimately know that the loan's coming, even though, everything hasn't gone through yet?
So sometimes you can get bottlenecks in that, like, late July, early August timeframe, just because of the volume that the schools are pushing through. I mean, they're focused and actively working as fast as they can, but you do get a lot of volume there. Usually with the school, once they've seen that loan and they've certified it, they know that it's happening, they will usually count that balance as paid, or they recognize that it's going to be paid most of the time. That is school by school. So it's not a promise that your school would recognize that, but it is relatively common that if schools see that they're certifying a loan, that they would sort of count that as paid.
So Kimberly is saying, you say apply now, but college financial aid officers are saying, wait, I assume they wait until new rates are out. And just so you know, Kimberly, was it last week? So the rates are out. So they might have been saying that, but and I'm assuming that they were meaning the federal rates. The federal rates were announced yet last week, and so that's a good time to start now looking. Looking at what rates you might get in the private loans and private lenders, and make a comparison to the federal rates.
Yes, and if they are referencing rates coming out, they are specifically talking about federal. And to your point, Debbie, those are out.
Okay, wow. I can't believe like an hour goes by and there's probably a lot of other topics and more questions that we didn't answer, but I think that we gave everybody a really good understanding of, some basic terminology, basically, how federal loans work and private loans, and that it's time to start researching and shopping and kind of gathering people's information relative to federal and private loans, and sitting down and having these conversations and getting the ball rolling. And it's not as scary. There was a lot of information shared, but it's really not that scary when you sit down and you get going with it. So
that's right.
Thanks, Angela, and absolutely everybody. And I'm going to put it in the comments after to go to the College Ave site. Is it what's your official URL? Is it collegeavstudentloans.com?
Collegeavstudentloans.com. Collegeav.com will get you there too. So
okay, I didn't know that. That's what I was. Yeah.
Yes,
okay,
they both work.
Okay, so collegeav.com. That's easier. They've got great content, and they really got tools. I mean, I'm a tool person. I love playing with the tools. So go there and check them out. Well, thanks again, Angela, and we're actually going to see you in a few weeks again in June.
I'll be back.
Yeah, so we'll be back. And if you have more questions that you come across, shoot them our way, and we'll try and answer more at, I think it's the second week in June.
Mm-hmm.
Okay, everybody. Take care. Good night.
Thanks, Debbie.